Something is moving in the quiet rooms where the largest pools of money on earth are managed, and the people who run those rooms are not going on television to explain it to you. They rarely do. The big banks, the trading desks, the financial press that depends on their advertising, they are very comfortable letting you believe that the smart money and the ordinary saver are playing the same game with the same information. They are not. And right now, there is a rotation underway, a deliberate, patient shift out of the things that only feel safe and into the one thing that has been safe for longer than any paper currency has ever survived. The professionals are doing it quietly. You are not supposed to notice until it is finished. If you are a retiree, if you have spent decades building a nest egg inside a 401k or an IRA, this matters to you more than almost anyone, because you are the one who cannot afford to be the last to understand it. So here is my promise for the rest of this video. I am not going to hand you a headline and a price target. I am going to walk you through how a rotation like this actually works, why it happens faster than anyone expects, and what the smartest, most heavily armed institutions on the planet are quietly telling you with their own money when they buy. Let me give you the one fact that should stop you cold, and it has nothing to do with what any price did this morning. The central banks of the world, the most conservative, slowest moving financial institutions that exist, have been buying gold at a pace we have not seen in modern history. For 3 straight years, they bought more than 1,000 tons a year, roughly double what they averaged over the prior decade. And gold has now quietly passed the euro to become the second largest reserve asset held by central banks anywhere, behind only the US dollar. Read that again. The institutions that manage entire nations' savings have already rotated. The question is not whether the smart money is moving into metal. It already has. The question is whether you will understand why before the crowd figures it out. To understand what is happening now, I want to take you back to a year that most people have forgotten, but that anyone who ran money at the time will never forget. The year was 1998, and it is the cleanest lesson we have in how fast the word safe can reprice, and how brutally the truly safe asset separates from the merely clever bets built on top of it. It started the year before, in Asia. Currencies that had been pegged and stable for years, in Thailand, in Indonesia, in South Korea, suddenly cracked. What everyone had treated as solid ground turned out to be a trapdoor. Money that had poured into those markets chasing easy returns tried to rush back out all at once, and there is never a door big enough when everyone runs at the same time. The contagion spread from one country to the next, not because their economies were identical, but because the same borrowed money was invested across all of them, and when it got scared in one place, it sold everywhere. That is the first thing to understand about a rotation. It does not respect borders or logic. It moves at the speed of fear. Then, in the late summer of 1998, the thing nobody had priced in happened. Russia defaulted. A nuclear power, a major nation, simply stopped paying on its own domestic debt and let its currency collapse. And here is why that single event mattered so far beyond Russia's borders. The entire financial world had quietly agreed that certain things simply did not happen. Big countries did not default. Certain relationships between markets always held. An enormous amount of borrowed money had been placed on top of those assumptions, on the belief that the safe patterns would stay safe. When Russia broke the unbreakable rule, every one of those assumptions came undone at the same moment. And that is where the character in this story walks in. And I want you to really see him, because he is the smartest person in the room. And that is exactly the point. Picture the men who ran the most celebrated investment fund of that era, a firm packed with Nobel Prize winners and the sharpest traders Wall Street had ever produced. They had built a machine that, on paper, could not lose. It made small, safe bets that certain prices would drift back toward each other, the way they always had. And because each bet was so safe, they borrowed enormous sums to make those tiny margins into large ones. Safe, multiplied by leverage, felt like genius. For a while, it looked like genius. Then 1998 arrived, and every safe relationship they had bet on moved the wrong way at once. The thing about leverage is that it does not let you wait for the storm to pass. When your borrowed positions move against you, the lenders demand more money, right now, and you have to sell whatever you can into a market where everyone else is being forced to sell the exact same things. Their can't-lose machine unwound in weeks. The Federal Reserve had to gather the biggest banks in a room and organize a rescue because the failure of one overleveraged fund threatened to pull down the whole system. The smartest men in finance, undone not by being wrong about value, but by owning cleverness on borrowed money when safe suddenly repriced. Now sit with the lesson because it is the whole spine of what I am telling you today. In that panic, the leveraged bets, the clever paper structures, the things everyone had called safe, they all fell together because they were all held by the same frightened borrowed money. But there is a category of asset that behaves differently in exactly that moment. The asset you own outright, free and clear, that is nobody's promise and nobody's liability, that cannot be margin called, that does not depend on a counterparty staying solvent. When the tide of leverage goes out, that asset is what is still standing on the beach. That is what gold is. It is not a bet on someone else keeping their word. It is the one financial asset that is not simultaneously somebody else's debt. And this is the part the big banks would rather you never really absorb, because their entire business is built on you holding their paper, their promises, their products. Let me be very direct with you for a moment, because this is the first place where what you own could genuinely fail you, and I do not want you to learn it the hard way. If your entire retirement is sitting in paper, in accounts that are all promises layered on other promises, then you are exposed to exactly the kind of moment we just walked through. A moment when everyone reaches for the exit at once and discovers the safe thing was leveraged after all. This is why I put together a free retirement protection guide and why I want you to have it before we go any further. Here is a truth the financial channels will not lead with. The central banks are buying gold at a record pace, and there is a perfectly legal, well-established way for an ordinary American to do the very same thing, to move a portion of retirement savings into physical gold and silver inside the account you already have, without triggering taxes and without penalties. It is called a self-directed precious metals IRA, and the guide walks you through exactly how it works. And let me be clear, this is not some club for insiders. If you have $100,000 or more in any retirement account, a 401k, a traditional IRA, this is for you as much as it is for anyone on a trading floor. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Get the guide, read it, and then come right back, because the rest of this is where it gets important. Now, here is the part that actually changes things, the part almost nobody connects. Because you might be thinking, that was 1998, that was a hedge fund. What does it have to do with me and my retirement in a completely different world? Everything. Because the same structure, the same trap has been rebuilt bigger than ever. And this time, it is not a single fund. It is the whole system. Look at what the central banks are actually doing. And remember, these are not gamblers. These are the most cautious money managers alive, and they are voting with real reserves. After a major power had its foreign reserves frozen a few years ago, something shifted in every central bank on Earth. They all looked at their own holdings and asked a simple, chilling question. If our reserves can be frozen by another country with the stroke of a pen, are they really ours? And they reached the obvious answer. Gold sitting in your own vault is the one reserve nobody else can freeze, nobody else can default on, nobody else can print more of. That is why the buying accelerated. It is not about chasing a price. It is about ownership that cannot be taken away. That is the rotation happening at the level of nations. And notice they keep buying even as the price climbs to record highs, which is the opposite of how a speculator behaves. A speculator chases a low and takes profit at a high. These institutions are buying regardless of price because their motive is not a trade. It is diversification. It is safety. It is ownership that cannot be revoked. When the most patient money on earth keeps buying an asset at record levels and does not flinch, that is not a bubble signal. That is a conviction signal, and it is a very different thing. And notice something strange about how gold has behaved lately, because it is the market quietly telling you the old rules have broken. For decades, there was an iron relationship. When real interest rates rose, gold was supposed to fall, because a bond that pays you a real return is gold's only true rival, the one thing that competes with an asset that pays no interest. That relationship held for a generation, and recently, it simply stopped working. Gold has climbed even while real yields stayed high, even while the math that used to govern it said it should not. When a decades-old relationship breaks like that, it is not noise. It is a signal that the thing driving the market has changed underneath, that this is no longer about the yield on a bond and everything about trust in the paper itself. And there is a bigger reason the old math stopped working, one that sits underneath everything else, and it is the quiet backdrop to this entire rotation. The developed world is carrying more debt than it ever has, at every level, government and corporate and household all at once. Governments now spend an enormous and growing share of what they collect just servicing the interest on what they already owe, a burden climbing toward levels not seen in generations. When a nation's debt gets that large, there is really only one politically painless way out of it, and history is brutally clear about what it is. You do not default openly the way Russia did. You inflate. You let the currency quietly lose value over years, so the debt shrinks in real terms, while nobody has to cast a single hard vote. The men and women who manage central bank reserves know this better than anyone, because they are the ones who would have to do it. And that is precisely why they are quietly trading a portion of their paper reserves for an asset that cannot be inflated away, an asset whose supply no government can vote to expand. When the people closest to the printing press start buying the one thing the press cannot produce, you should pay very close attention. And this is where I have to say something about the enemy in this story, because you deserve to understand who benefits from your confusion. The Fed's latest decision, a hold from a deeply divided group of policymakers, the current chair, Kevin Warsh, openly welcoming what he called a good family fight among them. All of that gets covered as a horse race, a drama of who dissented and what happens next meeting. And while everyone stares at that theater, the deeper story goes unmentioned, that the people who manage the world's real reserves have already decided they cannot fully trust the paper, and they are voting with metal. The financial media will give you 100 segments on the next rate move, and almost none on the quiet rotation underneath it, because the rate drama sells, and the rotation would make you ask uncomfortable questions about what you own. Let me bring silver into this, because it plays a particular role, and it is the one the leveraged world consistently underestimates. Silver has run a structural supply deficit for several straight years now, the world using more than it produces, drawing down the stockpiles that cover the gap. And unlike gold, which gets hoarded and sits in vaults, silver gets consumed, spread in tiny amounts across electronics and solar panels and industry, dispersed so thinly it is largely uneconomic to ever recover. Gold is hoarded, silver is burned. That is why when a rotation into metal gathers real force, silver tends to move harder than gold in both directions, and why the same leverage story sits on top of it. Mountains of paper claims on ounces that may not physically exist in the quantities promised. When SAFE reprices, paper silver and physical silver can turn out to be very different things. Here is what I need you to really hear now, because it is the thing the winners in 1998 understood and the losers did not. You are early. Right now, today, the mainstream has not caught on. The pension funds, the retail crowd, the neighbor who asks you for stock tips, they are still fully inside the paper, still trusting that safe means safe. But the smart money, the central banks, the most conservative institutions on the planet have already positioned. That is the entire tell. When the people whose only job is to protect a nation's savings quietly rotate into the one asset that is nobody's liability, they are showing you the trade before the crowd arrives. And by the time it becomes obvious, by the time it leads every news segment and every advisor on television is finally recommending it, the easy part will already be behind us. Nobody sends you an invitation to be early. There is no phone call, no announcement. Being early feels exactly like being alone, right up until the crowd shows up and you realize you were simply first. So let me be honest with you. The way the people selling you paper never will be, because this is a case, not a promise. I cannot tell you what gold will do next month or next year. I will not give you a price or a date, and anyone who does is guessing or lying. The metals are volatile. They can fall hard and fast, especially when leverage in the paper markets forces ways of selling that have nothing to do with the metal itself. This is a case built on history and structure and the visible behavior of the smartest institutions on Earth, and it is not personal financial advice, because I do not know your particular situation. What I can tell you is how to think about it soberly. Own the metal, not a promise of the metal. The entire lesson of 1998 is that when the storm hits, the thing you own outright behaves completely differently from the clever paper claim on it. Size your position so that a sharp drop can never force you to sell, because forced selling is how the leverage players got destroyed, And you never want to be the frightened seller dumping into a shakeout, handing your metal to the very desks that engineered the fear. Own it free and clear, hold it with patience, and do not let a violent dip shake you out of a position you took for the long, structural reasons in the first place. The people who survive these moments are never the cleverest. They are the ones who own the real thing and refuse to be rushed. Which brings me back to where we began, to those quiet rooms where the largest pools of money are managed, and to the rotation already underway inside them. The smart money is moving into metal right now, and it is not a secret because it is hidden. It is a secret because almost nobody bothers to look at what the central banks are actually doing instead of what the television is actually saying. You have looked. That already puts you ahead of most people your age with money at stake. And if you watch this all the way to the end, I want to give you the next step, not a sales pitch, a conversation. I offer a free, no-obligation, one-on-one educational web conference for viewers with $100,000 or more in retirement savings who watch to the finish and mentioned that they did. We will look honestly at your situation, at whether moving a portion into physical metal makes sense for you, with no pressure either way. And here is the honest reason to do it now rather than later. The moment to make a calm, unforced decision is precisely the moment when nothing feels urgent, before the crowd arrives and the choice gets made in a panic instead. That window is open right now. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. The smart money already rotated. The only question left is whether you move while it is still your decision to make.